People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost, for many folks, over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
The importance of time horizons in asset allocations. Let's talk about that this morning. Welcome to the Safe Money and Retirement Show. I'm your host, Jon Heischman. Asset allocation is knowing the time frames for the investor's financial goals, approaching retirement, and in retirement as well. Let me give you an example. If an investor is in retirement and needs to fund their retirement for the first 3 to 5 years, that goal would require an asset that's going to fluctuate a little, if at all, in price to ensure meeting that goal. On the other hand, a 25-year-old who is investing for retirement would invest in both stocks and bonds because there's plenty of time to ride out the volatility of stocks. So, the asset allocation of a specific investor needs to be tailored to that investor's goal. And this is another reason the importance to understand that asset allocation suggests only general guidelines that may or may not be appropriate for that individual. When I'm doing a retirement plan, this is something that needs to be included for each individual retiree. Given the superior performance of common stocks, why does the long-term investor invest in, let's say, bonds, T-bills, and other similar debt instruments? The answer is the fear of volatility or variability of returns, possible loss of principal. So the more stocks go down, the more likely an investor will eventually sell those stocks, which could be at a time when stocks are about to turn around. And this may very well lead to 2 negative consequences: selling at a loss and missing out on the rebound in stock prices. If part of your income is going to come from stocks, then this timing issue becomes important. Now, if income for retirement is not coming from stocks, or if it's in a bucket that may be used if needed or extra income later in retirement, that's okay. But one of the big reasons I stress guaranteed income sources for your retirement income is you don't have to worry about timing when to sell or to stay. Therefore, even if a large part of a retiree's portfolio is correctly allocated in stocks, a severe bear market could scare that investor into selling at a bad time. The correct time to have the portfolio properly allocated for clients is before, not after, the market goes down. Many people overestimate the amount of risk that they're comfortable with, especially if the market has been rising for a few years. And this goes back to the risk tolerance test. You've heard me talk about that on previous shows, how important that is. Because, as I said, people overestimate the amount of risk that they're comfortable with. It's really good to know. Another example, if an individual has funds, they're earmarked for a down payment on a home, college tuition for a child or grandchild, or even to provide cash flow during the early years of retirement, may legitimately be concerned with the possibility of depressed stock prices when they need the money. This fear as well confirmed during the 2002 and October 2007 to March 2009 periods, when stocks experienced severe bear markets. So it's very important to consider the time frame of a financial goal when deciding what assets to own for that particular goal. Here's a rule of thumb. Do not use stocks for any investment goal with a time horizon of less than 5 years. Another reason to put those stocks aside, not needing them, say for 5 or 10 years, because you have your income established. I just don't like my clients to rely solely on a portfolio of stocks. We just don't know how the performance is going to affect their income that they're taking from those stocks. All right, let's take a look at the other end of the spectrum. The person who retires in good health at age 62 with a large nest egg and says, I must invest entirely in government bonds because I cannot afford to lose principal. Here's what may happen. He may be losing purchasing power instead. Taxes and inflation will steadily eat away at the purchasing power of this retiree's nest egg, not to mention increased healthcare cost. The time-related concerns are interesting, that the risk of losing purchasing power with bonds over the long term can be countered by the returns above inflation that stocks may provide. On the other hand, the risk of loss of principal that is inherent with stocks in the short term can be countered by the low risk of loss of principal with short-term, high-quality, fixed-income securities. Again, it's all about timing, risk tolerance, and having guaranteed income sources. When you have guaranteed income sources, you don't have to worry about this. I think that's my point that I always try and stress in my shows. And a lot of these timing issues can be eliminated. These time-related issues should be addressed with each individual before starting any discussions about allocating their funds. I, as a retirement income planner, determine your time horizon and be attentive to the nature of your concerns. It's very different if you've got 15 or 20 years before retirement compared to 5 years, 1 year, or in retirement. By taking more risk, higher returns can be achieved. That will more than offset taxes and inflation based on history. Of course, these risks need to be sensible by owning high-quality stocks, not chasing that hot stock that many people do, as was the case in 1999 and early 2000. And this occurred with some technology and telecommunication stocks. On the other hand, if volatility is a major issue for you, then a more conservative approach is likely to be in order. Again, risk tolerance testing is critical. So I have to ask you, have you done in your retirement income plan a time horizon for when you're going to need the money? Because it's important. You can call me about this. We'll talk about your situation. As always, we have to eliminate those surprises that could occur in retirement because you were never told. This situation was never brought to your attention. 888-426-0177. Call me at that number, 888-426-0177. After the break, I'm going to continue my discussion on this topic and get into sequence of returns risk, which I think is very important. So be sure to stay tuned for the second part of the Safe Money and Retirement Show.
Life expectancy is at all-time highs, so that means you've got a future to plan for at any age. If you have longevity in your family tree, then you need financial education from someone with the experience and knowledge to guide you into and through your retirement years. Jon Heischman and the folks at Heischman Financial Services are committed to helping you achieve your retirement goals with a low-key and trustworthy approach. Call Heischman Financial Services today to get started on your retirement future. Call 1-888-426-0177. That's 1-888-426-0177. Heischman Financial Services has your future in mind.
This is Jon Heischman. I'm back to bring you the second part of the Safe Money and Retirement Show. I've been discussing time horizon issues and how important it is in your retirement planning. Investment issues for you could involve a misperception of risk. I feel that a client with a long-term horizon has to be provided with an appropriate frame of reference. This would be regarding investment performance, a rational basis for understanding that stocks go up and down, and that broad market of common stock losses are not permanent. That time is on their side, which you can weather through the volatility. And the biggest risk may be inflation. I always want to try and help the client think logically about which risk, price volatility, or even the erosion of purchasing power that could be caused by inflation. Now, this could be more important than the important ways that I can add value to each client's investment experience. So we come to what I think is one of the biggest risks that could face retirees. That is sequence of return risk. Before I get into sequence of return risk, I want to let you know that I can provide you with information about this retirement risk, which is about several pages long. And I want to make sure all my listeners, as well as any new potential client, is aware of sequence of return risk. It's free, no obligation, and all you have to do is call the number that I give you throughout the show. And I'm going to give that to you again, just in case you didn't pick it up earlier. 888-426-0177, 888-426-0177. I welcome your questions and can have a phone conversation with you to answer your questions. When an individual is in the accumulation phase, the order of returns is not really an overriding concern. Let me give you an example. An investor who is not adding to a position has the same return if the portfolio went up, let's say 20% in the first year, then it fell 20% in the second year. Or if the portfolio went down 20% in the first year and then up 20% in the second year. Either way, the investor who starts with, let's say, $1,000 ends up with $960. Therefore, the order of returns is a somewhat secondary matter when you are in the accumulation phase. The accumulation phase was when you were still working, contributing to your 401k, IRA, or any other retirement plan. Now, the situation is vastly different from retirement investors and those rapidly approaching retirement. When a portfolio has withdrawals, the sequence of return is critical. Now, when I say withdrawals, I'm referring to retirement income. This is because withdrawals of a fixed amount during investment downturns require more shares to produce the same withdrawal amount. This has been called negative dollar cost averaging. Here's an example. If shares drop to $5 a share, it takes 20 shares for the retiree to receive that same $100. The problem is that now the extra 10 shares are gone and would not participate in the investor's eventual recovery. Worst case scenario is large sustained losses early in retirement. The retiree must manage sequence of return risk in ways they may never have even considered during the accumulation phase. One way to manage sequence of return risk is to invest a larger portion of the portfolio in lower volatility assets. Another is called a bucket approach, where withdrawals come only from a conservative portion of the total portfolio, and the rest of the portfolio invested for higher returns. Now, this may sound complicated, and it can be if not properly addressed. I want to avoid sequence of return risk at all causes, and it can be done by making some adjustments as to where your income retirement is coming from. Here's a good example. When I use a 3-year bucket approach, the short-term bucket starts with 3 years of withdrawals that are in that bucket. Then withdrawals are taken only from that short-term bucket, low volatility investments. Now, over time, the short-term bucket is replenished from the long-term bucket. So, if the market experiences a large downturn, the withdrawals from the short-term bucket allow time for the rest of the portfolio to recover. I've talked about the bucket approach on previous shows and how it may apply to an individual's retirement income. The larger the short-term bucket, the more it defends against market downturn and sequence of withdrawals risk. But fewer assets in the long-term bucket may mean the overall portfolio does not have enough return for the portfolio to last over the long term. You might be thinking, John, this sounds too difficult, and it sounds like there's a lot for you to manage. But really, it isn't that difficult because the bucket approach I establish and it's managed by our firm. The bucket approach is not for everyone. It's just one way to set up an income plan if it applies to your situation. There are other retirement risk, and one of the big ones is longevity risk, retirement enhanced risk, and you even have the time on my hands risk. Too low of a return risk, weak defender risk, and scared me into selling risk, afraid to invest after losses risk. So the bottom line is we just prevent all of these risks, keep it simple so you don't have to worry about them. But I did want to bring them to your attention because there's a very good chance this is the first time you've heard of those risks. It's important to note that risk tolerance is greatly tied to one's age and time frame. As I have witnessed over the years, the longer the investment time horizon, the greater the risk the investor can afford to take. Other factors include investors' personality, past experience with investments, and current financial situation. So the best way for an investor to gauge their true risk tolerance is to complete a risk tolerance questionnaire, which is also called a test. I have my own questionnaire. However, samples and other risk tolerance tests can be obtained online. Typically, there's about 10 questions, and this is to design how to gauge an investor handles their money, their investment, time horizon, and how they would respond to market fluctuations. Once again, as you've heard me talk about over the years, the importance of guaranteed income as being part of your retirement income plan. Then we don't have to worry as much with sequence of return risk. I can help you with that risk tolerance test. I don't charge for that, and definitely there's no obligation, but it is something that every retiree, whether you're getting ready to retire or you've been retired for 10 years, you should have it done, because you'll find out what your real risk is, your tolerance for risk, and how you should invest. Let me know. Give me a call. I'd love to help in any way when it comes to your retirement planning. Let me give you the number, 888-426-0177. That number again is 888-426-0177. Don't forget to tune in next week for another edition of the Safe Money and Retirement Show. I'm your host, Jon Heischman, and want to thank you for taking your time to listen to my show.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.